Welcome back. Today we're doing Micron Technology, ticker symbol MU. They have an $86 billion market cap and are selling for $77 a share. So what does Micron Technology do? They design and manufacture information storage devices. There's more detailed description in the description of this video that I just got from the company's 10K. One other thing to note with Micron is that two pretty famous value investors, Guy Spear and Monish Pabrai, both own shares. So let's start with the share price history. So I just have a yearly graph here, and you can see earlier in the year we were at $100 a share. We fell to about $70 a share. It's on its way back up. Is this a time to jump in? Is it going to continue? Is it going to pass up that 100? I don't know. I'm not a technical trader, but what I will do is we'll do a valuation on this company and see if we get a share price higher or lower. So let's start with the income statement. All right, so first thing we're going to look at is total revenue. So this is about the last 10 years of data. So our first month you can see is 2/28/2011. So revenue, this is great. We love to see growing revenue. That's all we're going to get for revenue. We don't use it for any kind of valuation metric, but you should always at least lay eyes on it. Make sure you don't see it decreasing. All right, and then gross margin. So gross margin is pretty important for any type of manufacturing company. This is a great way to measure its competitive advantage because it shows how much of a premium it's able to charge for its products. As a general rule of thumb, over 40 is good, under 20 is bad, and between 20 and 40 is okay. And you'd like to see growing. So we're growing here, especially recently. Over 40%, that's great to see. So really like to see that gross margin. All right, and then the next thing we're going to look at is research and development as a percentage of gross profit. So what this tells us is, okay, the company makes a gross profit. How much of that is it having to spend on research and development to keep its edge over competition or to keep its share of the market? You got to be really careful with technology companies because some of them are spending a huge amount on R&D, and you just feel like if they miss 1 year or if they're just behind by a little bit, they could start losing sales. In this case, this is great. So you can see at the beginning of the period, they were spending a lot of their profit on R&D, sometimes more than their gross profit, look over 100%. But recently they've been spending a lot less. That's a good sign because it means that they're either making more gross profit or they're having to spend less dollars on R&D to maintain their market share. Both things are great, so that's a plus. All right, our first valuation metric is going to be pre-tax income. So y'all know this. I love pre-tax income because I think it's a great way to compare apples to apples. You don't have to worry about changing tax rates or write-offs, write-ons. This is a good way to get clean information on which way a company's going. So initial impressions are it's definitely a cyclical company. So the question is, are we on an upswing or are we nearing a peak? And that's really going to affect what number you put for your valuation. So me, I don't know that much about the company besides what I've read in its 10K and looking at these statements, but I'm going to take a pretty conservative number here and say I'm going to take the average of these last 2 quarters and multiply by 4. So the average of the last 2 quarters was 2.37. It's averaged off screen. You can't see it. So up here in the calculator, 2.37 is the average of the last 2 quarters times 4. That gives me a yearly pre-tax income estimate of $9.5 billion. So that's what I'm going to put in my outline over there on the left-hand side of the screen. All right, so now we are going to get the growth rate. So growth rate, remember, you always want to measure peak to peak. So what we're going to do is go back, 2 cycles. So it looks like in 2014, they were making about $1 billion a quarter. And let's say by 2020, they were making $2 billion a quarter. So what we're going to do here is do 2 divided by 1. To raise to the 2014 to 2020 is 6 years, so raise to the 1/6, and that's going to give us our annualized growth rate. So we're going to get 12% for that. All right, great. And then the last thing we're going to do is get the earnings per share from the income statement. So remember, always use diluted earnings per share. Just avoid surprises. So similar pattern to the pre-tax. The formula we're using is calling for the sum of the last 4 quarters, the trailing 12 months. So that's going to be what we use. So I'm going to sum these last 4, this one, this one, this one, and that one, the last 4 quarters. And that's going to be our earnings per share. So we get $5.15. So I'm going to put that over here, $5.15. All right, moving to the balance sheet. So the first thing we're going to look at is total tangible assets. So this is everything a company owns minus the intangible assets like goodwill and other intangible assets. So we're going to use this number to get a return on tangible assets, or ROA. I think that's a very good way to get a valuation on a company. It's very intuitive, kind of what you would consider if you were starting your own business. You would say, how many assets am I going to have to buy and how long am I going to take to pay back those assets? All right, so what we're going to do is take our pre-tax, and we're going to do it on a pre-tax basis. So our pre-tax number that we put in for the income statement, which was 9.5 billion, and divide that by the most recent number, which is, I'm going to get it down here, 57. So 9.5 divided by 57 is 17% return on assets. That is pretty good for a manufacturing company. You know, usually manufacturing companies have a lot of assets, so to get over 15 is strong. All right, next we're going to look at our assets are growing. Is our tangible equity growing, which is our total tangible assets minus our liabilities. And then we're going to divide that by the number of shares. This can also be called tangible book value, net tangible assets per share. I just call it tangible equity per share. All right, so this is awesome. This is the net worth of the company, is a way to think about it. It's like the liquidation value. And this climbing like fast as it is a great sign. I would be very cautious of any company that's making money, that's always meeting earnings, but their tangible equity per share is not growing. So to see this is great. All right, so we're gonna use this number to get a return on tangible equity after tax. So this is a per share basis, so we're going to use our earnings per share. So 515 divided by the most recent one, which looks like it's about 38. So 38. And we get 13.5% return on tangible equity. Also pretty good, but you always want to look at return on equity and PB ratio at the same time because they kind of go together. All right, so our tangible PB is going to be the share price, which we said is $77 a share, divided by the most recent tangible equity per share, so $38. So it's selling right at 2 times book value on a tangible basis. I think that is strong, especially with the high ROA for a manufacturing company and the decent ROE. This balance sheet is outstanding. This is one of the best ones we've looked at, I think, since we started doing these videos. So that's awesome. All right, moving to the cash flow statement. All right, the first thing we're going to look at in the cash flow statement is the free cash flow. Same thing as pre-tax, same thing as earnings per share. We like to see it growing. We expect it to kind of move in line with those, and it does. You can see it's still got that cyclical nature, and we're kind of nearing a peak lately. So in general, remember our pre-tax income was hovering around 2 or 3, so this is a little bit lower. This would make me think that we're going to have higher capital expenditures, and we're going to look at that right after this. But this is one of our valuation metrics. So we have to get a number here. Just like what I did for the pre-tax income, I'm going to take the average of the last 2 quarters, which is 1.6 billion per quarter, and multiply that by 4. So 1.6 times 4 is $6.4 billion a year in free cash flow. So let's look a little bit at why that free cash flow is lower than the pre-tax income. So first thing I'm gonna look at is depreciation, and okay, it's growing. We're depreciating about $1.6 billion a quarter in assets. That's how much our assets are losing value from a tax basis. And now let's look at how much we're investing into those assets or buying new assets. So that's gonna be capital expenditure or CapEx. And yeah, look at this. This is growing pretty significantly. So you're spending anywhere from 3 to 2 billion a quarter, way more than that 1.5, almost double in some cases, which is okay. You know, usually I'm tough on companies that are spending a lot on CapEx, but it's obvious that they're using it for growth. We saw that in the tangible book value per share or tangible equity per share growing. So I'm okay with increased CapEx as long as the company's growing. So just keep that in mind. Let's move to the last part, the valuation. All right, so our first valuation is going to be the pre-tax method. So this is going to be pre-tax income on a yearly basis times 10 divided by the number of shares. This is a great rule of thumb method, and it's worked really well for me. So 9.5 times 10 is 95 divided by the number of shares outstanding, so 1.12. And we get $85 a share. That's good. That's higher than our share price. All right, the next one is going to be this Ben Graham formula from security analysis. So we do $5.15 times 8.5 plus 2 times growth, 2 times 12. Yeah, wow. Okay, $167 a share. And our discounted cash flow model is going to be done on this little Excel graph and spit out this final number here that's highlighted. So we have 6.4 billion for our free cash flow. our perpetual growth rate is going to be, what I usually do is cut the growth in half. So 12 divided by 2 is 6, so 6. And my discount rate is 15%. So this is the net present value after 100 years, which is $82 billion market cap. So 82 divided by 1.12, so $73 a share, which is a little bit lower. All right, so we have 3 valuations around the share price, and one of them I would say grossly above what it's currently selling for. So let's look at each one and say, why did this one come in that way? So the first one, I think that's pretty in line, that we took a fairly conservative number for the pre-tax income. We didn't assume it was going to get any higher than the recent quarter. We took the average of the last 2 quarters. So I could see that being higher, definitely above 100, depending on what number you put in for your pre-tax income. The second one, I think our growth rate of 12% skewed it. If you want to back that out and do a smaller growth rate, you might get a more reasonable valuation. I'll just do a quick example of that. So what was it, 515? Let's say we did 8% growth instead. So 8.5 plus 8 times 2. So we get 126. I think that's more reasonable. And then the discounted cash flow method is obviously going to be lower because of the lower cash flow. And that's okay. You're willing to trade that off because you're expecting more cash flow in the future whenever they're investing that much in CapEx and still getting good return on assets. But anyway, I think this is a great company. Everything we saw, I don't think we saw a single red flag in the whole valuation. I can see why this is a darling of some of, our favorite value investors. So if you agree, if you learned something, if you enjoyed the video, please like and subscribe. And if you have any comments, questions, requests, leave them below. Thank you so much. I'll see you next time.